This video is a review of Marubeni's fiscal year 2025 first half financial results, the period from April 2024 to September 2024. Marubeni Corporation is a major Japanese trading company involved in global trade, investment, and infrastructure projects across industries like energy, food, and technology. Key factors. Net profit amounted to 238.1 billion yen, a decrease of 13.2 billion yen from the same period in the previous fiscal year. The progress ratio against the initial FY2025 full-year forecast, 480 billion yen, is approximately 50%. Adjusted net profit, excluding one-time items from net profit, was 224 billion yen, a decrease of 20 billion yen from the same period in the previous fiscal year. The progress ratio against the initial FY 2025 full-year forecast, 460 billion yen, is 49%. In terms of the breakdown of adjusted net profit, in the non-resource fields, aerospace and ship, chemicals, forest products, and others saw increased profits, while profits in construction, industrial machinery and mobility, food too, agribusiness, and others decreased, resulting in 161 billion yen, a decrease of 4 billion yen from the same period in the previous fiscal year. In the resource fields, the profit was 60 billion yen, a decrease of 11 billion yen, due to decreased profits in the coking coal business, iron ore business, and others, caused by declining commodity prices. Core operating cash flow increased by 39.5 billion yen year-on-year to positive 305.9 billion yen in response to the increase in dividend income and others. The progress ratio against the initial FY 2025 full-year forecast, 570 billion yen, is 54%. As for the balance sheet, shareholders' equity as of September 30th, 2024, was 3.4 trillion yen, with a decrease of approximately 70 billion yen from the previous fiscal year-end. This was due to a decrease in translation adjustments caused by the stronger yen and others, despite an increase in retained earnings from accumulated net profit and others. Consequently, net DE ratio stood at 0.64 times, with a 0.09-point increase from the previous fiscal year-end. Net DE ratio. Net debt to equity ratio is a financial metric that measures a company's financial leverage by comparing its net debt to its shareholders' equity. It indicates how much of the company's operations are financed by debt relative to its equity. Lower point is better, but the net DE ratio increased this time. As resource market prices were predicted to fall from earlier, the financial results were in line with expectations. Full-year forecast for FY 2025. The full-year forecast remains unchanged, with the initial FY 2025 full-year forecast for net profit at 480 billion yen and adjusted net profit at 460 billion yen. While the overall forecast for adjusted net profit remains unchanged, the breakdown has been revised. In the non-resource fields, power and others saw increased profits, while profits in agribusiness, food too, and others decreased, resulting in 317 billion yen, a decrease of 4 billion yen. In the resource fields, taking into account the impact on the metals and mineral resources division from declining coking coal and iron ore prices, the forecast was revised downward by 7 billion yen to 140 billion yen. Although the forecast for adjusted net profit in the non-resource fields has been revised downward to 317 billion yen, it is expected to achieve around 300 billion yen for the fourth consecutive year. Meanwhile, the forecast for core operating cash flow has been revised upward by 10 billion yen to 580 billion yen, almost the same as the record high of 584.2 billion yen achieved in fiscal year 2022. Net D ratio at the end of March 2025 is forecasted to be around 0.6 to 0.7 times. The annual dividend per share for fiscal year 2025 remains unchanged from the initial forecast at 90 yen per share. Progress is going well so far. This fiscal year's performance is expected to be in line with the forecast. Profit by segment. The results based on the graph of adjusted net profit in the lower half of the page. The resource segments. In metals and mineral resources, adjusted net profit decreased by 13 billion yen year-on-year to 60 billion yen due to the lower commodity prices in Australian coking coal and iron ore businesses and the profit decrease in the steel product business. As for the copper mine business in Chile, despite the rise in copper prices, net profit remained at the same level as the previous year due to an increase in mining costs. In the second half, significant net profit improvement is expected, with an improvement in costs, along with higher market prices. In energy, profit decreased by 5 billion yen year-on-year to 14 billion yen because of the normalization in the energy trading business, which was strong in the previous year. Next, non-resource segments. In aerospace and ship, profit increased by 7 billion yen year-on-year to 19 billion yen due to increased profits in the aircraft parts business and in the ship owning and operating business due to improved shipping market conditions compared to the previous year. In chemicals, profit increased by 5 billion yen to 7 billion yen due to an improvement in petrochemicals trading, which was weaker during the previous year and others. In forest products, profit increased by 4 billion yen to 7 billion yen due to the higher pulp market prices and a profit increase in the hygiene products manufacturing and sales business in Brazil. In finance, leasing, and real estate business, profit increased by 2 billion yen to 25 billion yen due to the start of recognition of equity in earnings following the conversion of Mizuho Leasing Company into an equity method affiliate, as well as an increase in profit from Aircastle business in the U.S., despite a profit decrease in Now Lake business in the U.S. In construction, industrial machinery, and mobility, profit decreased by 5 billion yen to 10 billion yen due to decreases in profits from construction machinery business and others. In food too, profit decreased by 5 billion to 6 billion yen due to decreases in profits from the livestock businesses such as Wellfam Foods in Japan and Creekstone Farms in the U.S. In agribusiness, as profit decreased at Helena in the U.S., affected by decline in farmers' income due to falling grain prices, along with lower agri-input prices and others, the profit for the segment decreased by 4 billion yen to 21 billion yen. Adjusted net profit growth in non-resource fields. Resource business is largely influenced by market prices. Marubeni is also focusing on non-resource fields, which are relatively stable. FY2025 full-year forecast for adjusted net profit for the non-resource fields is 317 billion yen, expected to achieve around 300 billion yen for the fourth consecutive year. Growth investments are continued to be allocated mainly to the existing business domains centered on the non-resource fields with competitive advantages. Simultaneously, investments to new business domains will be enhanced to establish future earnings pillars. Marubeni focuses on continuous growth investments to enhance capital efficiency and strengthen competitive advantages in each business. Shareholder returns. Annual dividend per share for fiscal year 2025 is forecasted to be 90 yen, based on the strengthened earnings base. For fiscal year 2025, a 50 billion yen of share buybacks has been conducted using free cash, which is the surplus from accumulated management resources. As the buybacks have been funded by free cash, total payout ratio is expected to be 42%. Marubeni follows a progressive dividend policy, targeting a total payout ratio of 30 to 35%, with flexibility for share buybacks and aims to increase dividends in line with medium and long-term profit growth. Stock price. This is the Japanese yen-based chart for the last 1 year. The Japanese yen stock price is 2,279 yen as of December 5th, and the US dollar stock price is $152.81 as of December 4th. Current PBR is 1.12, and PER is 7.47. Dividend yield is 3.95%. Compared to the last few years, current PBR and dividend yield are about the same, but PER is relatively higher. PER was lower in the past because of higher earnings per share, thanks to higher resource market prices. But dividend yield of 3.95% is still a good high yield. Conclusion. Like many other trading companies, profits from the resource segment is expected to decrease over the next few years. Furthermore, if the yen continues to appreciate in the future, this will have a negative impact. But earnings per share and dividend amount is forecasted to increase compared to last year, and Marubeni is still very proactive in returning profits to shareholders through progressive dividend policy and share buybacks. First half progress rates are about 50%. Financial results this time was as expected and in line with the forecast.